Hi, I'm Bob Jaswinski. Over the next 10 minutes, I'd like to share with you our current views on the economy and the financial markets. Generally, we're optimistic that the conditions over the next few years will continue to be positive, both in terms of global economic growth and returns from broadly diversified global common stocks. The Purchasing Managers' Index measures manufacturing momentum throughout the world. Readings over 50 indicate that manufacturing is expanding, and readings less than 50 indicate the opposite. Readings throughout the world today are generally good. The index for global manufacturing is currently 52.7, among the highest readings over the last 18 months. Many countries in the world are higher, with the United States at 57.3, Canada at 53.5, the United Kingdom at 57.5, Spain at 54.6, Ireland at 55.3, and Taiwan at 54. There are four sectors of the economy that typically take us into recessions when they are contracting and bring us out of recessions after bottoming and beginning to expand: light vehicle sales, housing starts, manufacturing and trade inventories, and real capital goods orders. Light vehicle sales are currently running at about 16.9 million per year. This is greater than the average over the last 20 years, but less than the peaks reached prior to 2008. Recent reports continue to show strong auto sales. With the average age of vehicles on the road and projected demand, vehicle sales are likely to remain strong. Housing starts are running at about 1,001,000 units per year. This is less than the 20-year average of 1,355,000 and less than half of the peak start seen prior to 2008. There are reports that many young people today are delaying forming households and having children. Also, the percentages of people who are renting homes today is higher, but the overall economics in most regions of the country continue to favor owning homes over renting. Up from the low point reached in 2009, housing starts should continue to benefit economic growth. Manufacturing and trade inventories are running at some of the lowest levels over the last 20 years in terms of days of sales in inventories. Real capital goods orders are an indication of business investment. As sales growth occurs, goods will need to be produced to meet demand and also to replenish and build inventories to support further sales growth. Although many businesses today are able to better manage days of sales and inventories with technology, higher levels of sales will likely require an increase in inventories. Business investment typically increases as unemployment declines. In the tighter labor markets that many industries are facing today, business investment will likely continue at robust levels as businesses make productivity-improving investments. Corporate profits hit a record high in the last quarter of 2013 and are forecasted to be another record high after the second quarter of 2014. Profit margins are high as a percentage of sales at about 8.9%. Corporations generally have low levels of debt, as the bottom right quadrant of this chart shows. Corporations also have high levels of cash. Corporate cash can be used to fund productivity-improving investments, increases in dividends, and purchases of the corporation's common stock. All of these uses of cash can potentially be very beneficial to future returns on stocks. The bottom right quadrant of this chart shows record high levels of household net worth. Personal balance sheets have been repaired with increases in residential real estate prices and high returns on most stock market investments. Low interest rates and reduced levels of debt have produced one of the lowest debt service ratios we've seen over the last 35 years. These fundamentals reflect increased consumer buying power that should also lead to further increases in economic growth. So, for the most part, we believe that economic fundamentals are generally very positive and should support continued decent returns from stocks. For the next few minutes, I'll review some of our thoughts on the financial markets. The history of the Standard & Poor's Composite Index has reflected long periods of flatness. Eventually, though, stocks have left the plateaus and moved on to higher highs. That is reflected after 1948, 1974, and is likely occurring now after 2012. Stock prices move higher, primarily due to increasing levels of corporate profits. The ingenuity of private enterprise, constantly solving problems and seizing opportunities, prompts the increases to corporate profits over time. The S&P 500 index is currently trading at a price-earnings multiple of about 15.6, which is also the average price-earnings multiple over the last 25 years. Price-earnings multiples have generally been higher during periods of low interest rates, as we have now. The earnings yield on the S&P 500 index is currently 6.4%. The Moody's Baa bond yield is 4.7%. Since stocks have a higher earnings yield than bonds, stocks are judged to be a better investment going forward than bonds. As you review the bottom right quadrant of this slide, you will see that stocks' earnings yields in excess of bond yields, as we have now, is not consistent with the longer-term trend of greater bond yields. As interest rates increase and the stock earnings yield declines, the relative attractiveness of stocks over bonds will diminish. Over the last 34 years, there have been 26 up years in the stock market. An intra-year decline has occurred in every one of the 26 up years. The average intra-year decline was 14.4%. Recently, I heard a report that the stock market has not experienced a 10% decline for the last 1,000 days. As interest rates begin to increase, it is very likely that stock market volatility will increase too. That, along with the history of intra-year declines, leads us to expect a stock market correction at any time. Stocks are an appropriate investment for long holding periods, but less so for shorter periods of time. In summary, then, we do expect a continuation of the global economic expansion and further increases in most global stock markets. There will likely be periods of increased stock market volatility, but overall global stock market valuations imply to us that globally diversified common stocks will continue to produce decent returns. We do expect those returns to be substantially less than the returns over the last 5 years. 5 years ago, stocks were coming off very low levels reached in March 2009. The protection for most investors should continue to be in your overall asset allocation. One way to benefit from stock market volatility is never to have to sell stocks when prices go down. That can be achieved by having sufficient amounts of cash and relatively stable value bonds to fund spending and unexpected needs during the many periods that stocks decline. Thank you for watching this video. We appreciate the opportunity to assist you and urge you to contact me or your lead advisor if you have questions or desire discussion.